So welcome to our today's class. There is the advanced financial reporting and analysis. We did on our previous class on what we call the segment reporting, which was on what we call the operating segments. So today's class, I want we talk of a new topic, which is on what we call the impairment of assets. On top of that, this is advanced financial reporting and analysis. We want to talk of the impairment of assets. Impairment of assets. This is under IAS 36. Impairment of assets, IAS 36. That is the topic that I want to cover today. Impairment of assets, IAS 36. Impairment of assets, that is on IAS 36. Impairment of assets, that is IAS 36. Now, an asset is said to have impaired if its carrying amount exceeds the recoverable amount. Now, when we talk about the carrying amount, is the amount that we present the item in the financial statement. Recoverable amount, we say, it is the higher of these two. Recoverable amount should be the higher of either the value in use, or what we call the fair value less cost to sell. Fair value less cost to sell. Now, what do we mean in this case? When I talk of the value in use, we mean the present value of future benefits. The present value of future benefit for the service potential of that given asset. That is what we mean when we talk of value in use. Present value of future economic benefit for the service potential of that given asset. When I talk of the fair value less cost to sell, is the selling price of that asset less the selling cost. The cost that you incur when you are selling that item. Probably you have made an advert. The cost of advertising for it is what we call in the cost to what? To sell. Are we together? So for us to know the recoverable amount, we have to know the value in use and fair value less cost to sell. So in our case here on the impairment of assets, we'll be able to know what are the indicators of impairment losses, where we categorize them into two. There is the external indicators and we have the internal indicators. That is mostly what we'll be able to know. And then we'll also be able to understand. Sometimes we use in impairment of assets, like what we call the cash generating units, cash generating assets, and so forth. So you can begin and say, you write, and you say, an asset is said to be impaired. An asset is said to be impaired. An asset is said to be impaired if the carrying amount exceeds, say to be impaired if the carrying amount exceeds the recoverable amount. Say to be impaired if the carrying amount exceeds the recoverable amount. Recoverable amount. And you say, carrying amount is the amount in which carrying amount is the amount in which carrying amount is the amount in which the asset or the liability is shown. The asset or the liability is shown the asset or the liability is shown in the financial statement. Is shown in the financial statement. Say, is shown in the financial statements. Is shown in the financial statements. You see, recoverable amount is the higher of. Recoverable amount is the higher of. The number one, you can have colon and you have number one, the value in use. Number two is the value in use, and number two is the fair value less cost to sell. Fair value less cost to sell. Fair value less cost to sell. Right, and say value in use is the present value of future economic benefits. Say the value in use is the present value of future economic benefit for the service potential, for the service potential, for the service potential of the asset, for the service potential of the asset, for the service potential of the asset. Also add and you say the value less cost to sell. The value less cost to sell is the selling price of the asset or the item, is the selling price of the item. The value less cost to sell. The value less cost to sell is the selling price. The selling price of the item less the selling cost. The selling price of the item less the selling cost. Selling price of the item less the selling cost. And have indicators of impairment. Indicators of impairment. Indicators of impairment. For indicators of impairment, as I've said, we categorize them into two. There is the external indicators and we also have the internal indicators. So we can begin with the external indicators. External indicators. External indicators. Number one is a significant decrease in asset market value. Significant decrease in asset market value. Significant decrease in asset market value. In asset market value. Number two, can talk of significant changes with a diverse effect. Significant changes with a diverse effect to the asset or the liability. Significant changes with a diverse effect to the asset or the liability. The assets or the liability, such as the technological changes and legal environment, such as the technological changes and legal environment, such as the technological changes and legal environment. The one is an increase in market interest rates. Increase in market interest rate. Increase in market interest rates. And those increases are likely to affect. Those increases are likely to affect the discount rate. And those increases are likely to affect the discount rate. Are likely to affect the discount rate. used in calculating the value in use, likely to affect the discounting rate used in calculating the value in use. Value in use. Now, those are the external indicators. Can have internal indicators of impairment losses, the internal indicators of impairment losses. Internal indicators of impairment losses. Number one. One is the evidence of internal inefficiency. Evidence of internal inefficiency. Evidence of internal inefficiency. Then number two, you can talk of the physical damage. The physical damage of the asset. Physical damage of the asset. So mainly we can talk of those two as the internal indicators. Definition of terms. Definition of terms. The definition of terms. Begin with the cash generating assets. Number one is on cash generating assets. Now, when we talk of a cash generating asset, we are talking of those assets that you held them to generate what we call the commercial returns. Commercial returns, we mean to generate income. So you write and say these are assets held. These are assets held to generate commercial returns. To generate commercial returns. To generate commercial return. Number two, cash generating unit. But who is the cash generating unit? Cash generating unit. From that you can say these are a group of small identifiable assets. Is a group of small identifiable assets. Small identifiable assets held with a primary objective. Small identifiable assets were held with a primary objective of generating commercial returns. Held with a primary objective of generating commercial returns. Commercial returns. That one is now the non-cash generating assets. Non-cash generating assets. Non-cash generating assets. So these are other assets. The other assets other than cash generating assets. The other assets other than cash generating assets. And those are the definition of the terms. Now write NB down there. And this is very important. You need to understand this. So UNB. Now we want to talk of in case of what we call the impairment loss. How do we allocate the impairment loss to the cash generating assets? So write and say, in case of impairment loss, of cash generating assets, in case of impairment loss of cash generating assets, in case of in case of impairment loss of cash generating assets, the allocation is made as follows. The allocation is made as follows. Number one, first reduce the carrying amount. First reduce the carrying amount of any goodwill. First reduce the carrying amount of any goodwill. Carrying amount of any goodwill. Number two, then reduce to the other assets in cash generating units, then reduce to the other assets in the cash generating units, in proportion. The other asset in the cash generating units to the proportion of their carrying amount. To the proportion of their carrying amount. The proportion of their carrying amount. Then reduce to the other assets in the cash generating units in the proportion of the balances, or in the proportion of the amount they are carrying, the amount in their carrying. In the proportion of what? In proportion of their carrying amount, not amount in the carrying amount. I will repeat myself. So in proportion of their carrying amount. Now this is what I mean. First, here we will be determining what we call the impairment loss. And simply, impairment loss is just the carrying amount you less the recoverable amount. Recoverable amount can either will be the higher of these two. The value in use, or what we call the fair value less cost to what? Fair value less cost to sell. That is what we mean when we talk of the recoverable amount. Are we together? Then, in this case, once we determine the impairment loss, the examiner may want you to allocate to the cash generating asset that the organization may be having. In other question, it will ask you with explanations, show the allocation of impairment losses to the assets of the entity. The allocation will be done as I've been able to dictate there. If there is any amount of goodwill, and when I talk of an amount of goodwill, we mean the whole goodwill, you have first to reduce the total amount of that goodwill. Then what remains, you will apportion to the other assets in respect to the balances or the amount that they have in their financial world. And that is the carrying amount. We mean the balance as at the financial world, financial year end. So that is how we allocate for the goodwill. You can have an example. Write this example. You can have an example and you say, ABC Limited owns a manufacturing plant. ABC Limited owns a manufacturing plant, with a carrying amount of 7.49 million. With a carrying amount of 7.49 million. With a carrying amount of 7.49 million. Say, the government has embossed export quota. Government has embossed export quota on product manufactured by the plant. Export quota. Government has embossed export quota on product manufactured by the plant. Say, following this development, ABC Limited, following this development, ABC Limited has prepared the following estimates of cash flows prepare the following estimate of cash flows from the usage of plant, for the usage of next 5 years, from the usage of plant for the next 5 years, from the usage of plant for the next 5 years. This is the cash flows I will have the year. Cash flows, I need them in thousands. Year 1, 2,300. Year 2 can have the year 2 should be 2,110. Then year 3 is 1,570. Year 4 should be 1040. Year 5 is 2,330. 2,330. Same. The plant can be sold currently. Plant can be sold currently for 5.6 million. For 5.6 million. And the selling cost will amount to 5.6 million, and selling cost will amount to 100,000. Will amount to 100,000. Cost of capital is 15%. The cost of capital is 15% required. Number 1, recoverable amount of the plant. Recoverable amount of the plant. Recoverable amount of the plant. But through the impairment laws. Impairment laws of the plant. Impairment laws of the plant. The first thing we want to know what will be our recoverable amount. That is what we want to determine. The recoverable amount. Recoverable amount is the higher of these two. The value less cost to sell, then the value in use. Let me begin with the fair value. The value less cost to sell. Now, their value less cost to sell will be given by the asset can be sold for 5.6 million, right? But the selling cost will be 100,000, which means in this case it will be how much? It will be 5.5 million. That is what will be the fair value in use. In less cost to sell. Then the value in use, I've said, is the present value for the remaining service potential of the asset. So meaning that I'll get the present value of these cash flows. I love the year, love the cash flows. Present value interest factor, this is 15%. So that we get the present value. Present value. So we have from year 1, 2, 3, 4, and 5 cash flows here. This is 2,300,000. Year 2 is 2,110. Year 3, 1,570. Year 4, it is 1,040. Year 5, it is 2,330. 2,330. Now, present value. In financial reporting, you are not given tables, so you need to know the formula. To get the present value is 1 plus what? R power negative n. So that okay? So that means this will be 1.15 power negative 1. Should be 0.8696, somewhere there. Yes? Is it giving you that? Umepata hivyo? Our negative 2 should be 0.65 watt. Ammonium B. We can continue guessing. Uh, is it 0.5718 somewhere there? Or I don't know. Is it that way? In year 4? Year 1, year 2, year 3? Yeah. I'm not having a calculator. So you can tell me. This is 0.4972. I think I can also have this as 0.4. Is it 323? Is it okay? Mnaona hazifanani na mniambie. Ana iko sawa? Sasa si ndio mniambie. Ya kwanza ni gani? Ya pili? Oh, this should be 75. Oh, sasa 7565. Hivyo. So this one would be 0.6574. I mean 04. Hivyo. Or 6575. Oh, this should be 61 then. No. And this will be 0.57. And then this 0.4972. Oh, then you can multiply. Then can multiply. Inakupea ngapi? Yes. 2 million. 2 million and 8. All right. Second one. 395. 37.371. The other one. 1032. 275. The other one. 594. The other one. So get the total present value. Total present value. Total present value. Total present value may equals to how much? 63? 874. That way. So now, what will be our recoverable amount? Between the fair value less cost to sell and value in use, which is the highest? So our recoverable amount will be 63, 871. So we can now get the impairment loss. Impairment loss will be the carrying amount, which is of how much? 71. Was 7.6? Kwa ngapi? 49 million. So it's 70 for 90,000. You less the recoverable amount. What is the recoverable amount? What is the recoverable amount? 65, 63, 874. So what will be our impairment loss? 1,109,126. That is the impairment loss. That is the impairment loss. That is the impairment loss. Now we do August 2022, question 2A. Do August 2022. August 2022, question 2A. August 2022, question 2A. August 2022. Join the group. Take from the group. Let me reach it. Or today. All right. All right. Let me reshare. August 2022, question number August 2022. We do question number question number 2A. August 2022. August 2022. Question 2A. August 2022, question 2A. Halima, you've seen the question? The one that I've shared in the group? Check question 2A. August 2022, question 2A. This is what the question reads. B Limited operates a factory as its sole cash generating unit. During the year ended 30th April 2022, there was an explosion in the factory which necessitated an impairment review. Given that the carrying amount of the factory assets was as follows. Given the goodwill, patents, machinery, computer equipment, and we have the premises. Additional information, an impairment review revealed a net selling price of 19.2 million and value in use of 31.2 million. Half of the machinery had been destroyed and half had no resale value. Patents have been superseded and are now considered worthless. Company follows the cost model as permitted by IAS system, property, plant and equipment required. Discuss with a suitable calculation how any impairment loss in the cash generated units will be accounted for in accordance with IAS 36, impairment of assets. Impairment of assets. we can just do the question. So the first thing is first we identify the new carrying amount. The carrying amount that is from the balance is there. So carrying amount. So here I'm going to have the asset. Then we'll have the cost as that now. We'll have the, yeah, I can say it as accumulated depreciation. So that we can have the carrying amount. Now, the first one was goodwill. Goodwill was of how much? Shillings I use in thousands. Shillings in thousands. Shillings in thousands. So the first one, the goodwill is having an amount of 2. From additional information, nothing was affecting the goodwill. So the amount still remains. Patents, we were told that they were considered valueless, therefore should be written off, right? So they are considered worthless, therefore we're not going to include them. The other one was machinery. Machinery. Initially, the machinery was 4,000. Half of it was destroyed. So half of 4,000 is 2,000. So what remains is 2,000. Computer equipment. Computer equipment. Computer equipment was 8,000. Nothing affected them. So it will be 8,000. And then also the premises. Premises was of how much? Premises was 30,000. So get the total carrying amount. Total carrying amount. It is how much? Yes? 42,000. That is 42,000. Now from there, we can get the impairment loss. Impairment loss. First, what will be our recoverable amount? Recoverable amount. Our recoverable amount will be the value in use. Their value, sorry. Their value. Less the cost to sell, which we were given the selling cost on number 1 was 19 what? 200. We are using shillings in thousands. And then we had the value in use. Value in use was how much? 200. You choose the higher. The higher here will be how much? Will be this that what? 31,200. And therefore, our impairment loss carrying amount, you take the carrying amount, which is 42 million. We are using shillings in thousands. You less the recoverable amount, which is how much? 31,200. So how much is it giving you? What is our impairment loss? 10. Impairment loss is 10,800. Right? Now we can now have the allocation of this impairment loss. And this is where we were required to discuss the allocation of these impairment loss. How do we allocate now this 10,800 to these assets? So here I will also have the asset again. We have their carrying amount. Carrying amount. Here is now the impairment loss. Impairment loss. So that now we can have their new carrying amount. The new carrying amount. New carrying amount. Shillings in thousands. Shillings in thousands. Shillings in thousands. Right? So we begin. Now the assets here we have the goodwill. Goodwill. This was of 2. We have the machinery. Their carrying amount here is 2,000. We have the computer equipment. Computer equipment, which was of how much? 8,000. Then we have the premises. Premises. This was 30,000. The total ilikuwa ngapi? 42,000. Now we want to allocate the impairment here. Our impairment is of how much? Our impairment here was, we've gotten 10,800. We want to allocate this impairment to all those assets. Now, the first thing that we said, we reduce any amount of goodwill, right? So any amount of goodwill here is of 2. So already here now it remains 800. So we'll now allocate to these other assets in proportion to their carrying note amount, which in this case will be 8 plus 2,000 plus 8 plus what? So for machinery, the impairment will be of how much? You just take the 2,000, I divide by 40,000. You know the 40 we have gotten it? This total is what we are portioning. So that's how allocating. You multiply by the balance of that impairment. So that's how. You'll also do the same for equipment, the computer equipment, the computer, which will be also 8,000 divided by 40,000. The remaining amount of impairment, 800. And then also you do the same for the premises, which will be 30,000 all over 40,000. You multiply by 800. For machinery, you've gotten how much? 440. That is for machinery. What about for computer equipment? Yes? 1760. So 1760. What about for the premises? 6,600. So you can get their new carrying amount. New carrying amount, we know the impairment loss will reduce the value. So this will be 0. Right? I've said the 40K is there. You will not apportion for the goodwill. This is the 40K. Now what remains? After I've reduced the whole goodwill, this is what has remained. Your portion depending on the total for that. What I mean is you get in 2,000 plus the 8,000 plus 30,000. That is what is given as the 40 total. 40,000. So this is 6,600. So what is their new carrying amount? What is their new carrying amount? Hamjapata. Kuna shida? Oh, ya kwanza. This one will be how much? This other one? 60 what? Yes? 62.14. And this one will be 21, 23. One. So get the total. That 1. But now this will not give you the 10 watts because the question is asking you to do it. With the discussion, what you have shown us is just the working. So how do you discuss this? You are to discuss how impairment loss in cash would be accounted for. You write and say the impairment loss will be accounted as follows. Impairment loss will be accounted as follows. First, reduce the total amount of goodwill. The total amount of goodwill. That is the 2 million. That is the 2 million. Number 3, apportion the remaining amount of the impairment apportion the remaining amount of impairment apportion the remaining amount of impairment to the other assets, to machinery, just say to machinery, computer equipment and premises. Machinery, computer equipment and premises in proportion of their carrying amount. In proportion of their carrying amount. In proportion of their carrying amount. So, Kevin, what we've done is that we have eliminated the 2 million for the whole goodwill. What remains here? The 10,800 minus 2,000 for the goodwill. The 8,800 is now what we are apportioning to the remaining other assets. And it's just that. That is how that question was to be done. Is that okay? Now we can proceed. Let's talk about the impairment loss. We can talk of now the impairment loss for non-cash generating assets. Impairment loss for non-cash generating assets. impairment loss for non-cash generating assets. Now, generally for the impairment loss for non-cash generating assets, we talk of those that are in what we call the what? The government entities. So you write and say, this is under IFRS 26, IFRS 26, IFRS 26. And you can write and say the following approaches. Following approaches are used to determine. Following approaches are used to determine the value in use, and the impairment loss, value in use, and impairment loss under the IFRS, and the impairment loss under the IFRS, impairment loss under the IFRS. Number one is depreciated replacement cost method. Depreciated replacement cost method. Depreciated replacement cost method. Depreciated replacement cost method. Number two, restoration cost method. The restoration cost method. Restoration cost method. And number three, what we call the the service unit. Service unit approach. Service unit approach. Now let's begin with the depreciated replacement cost method. Replacement cost method. Depreciated replacement cost method. And you see, under this method, the present value of the remaining service potential, the present value of the remaining service potential of the asset, present value of the remaining service potential of the asset is determined as the depreciated cost of the asset, is determined as the depreciated cost of the asset. Now, when I talk of present value, we are talking about the value in use. So, value in use is what will be our recoverable amount. So this is what we mean. Under this method, you just set the cost of the asset. You minus the accumulated depreciation. Accumulated depreciation. So that you get the carrying note. This will give us the carrying amount. Carrying amount. This is what we mean by my A. Then we'll take the replacement cost. Replacement cost. You less the accumulated depreciation. The accumulated depreciation. This is of the replacement cost. So that what we will get here is what we call in the depreciated replacement cost, which will be our recoverable amount, or generally the value in use. That is what will be our recoverable amount or the value in use when you less that. So that Once you do that, for me to get the impairment loss will be A minus B. That is what we call the impairment loss. A minus B. The A minus B. December 2014. Can do December 2014 question 5B. December 2014 question 5B. That is now from the other paper that I've given there. Use the old paper. These are from May 2015. Can use that one. So that we do December 2014. That should be question number 5B. You there? Use the other paper. Now, 5B Roman 1 is what I want to do. You are given that on 1st January 2009, government purchased a software license for 350 for an application on its mainframe computer. Government that the useful life of this estimated that the useful life of the software would be 8 years, and that if it would receive benefits and service potential from the software on a straight line basis over its useful life of that software. As of 31st December 2013, usage of application had reduced to 15% of its originally anticipated demand. A license from the software application to replace the remaining service potential of the existing software application would cost 150,000 required. Impairment loss to be recognized for the software using the depreciated replacement cost approach. So we'll just do it as I've said. You'll have the cost of the software. This is of how much? 350. Less the accumulated depreciation. Accumulated depreciation. Now, accumulated depreciation, we know it was 350,000, useful for how many years? 8, but it had been used before the replacement that they want to replace. It had been used for how many years? From 09 to 2013, December. How many years? Sure. From 1st January 2009, 2010, 2011, 2012, or this is 2013. So it should be how many years? 5 years. So for 5 years, it will have accumulated depreciation of how much? 218. 750. Get our carrying amount. 131, 250. That is that. Then we'll have a replacement. If they replace the asset, they will replace it at a cost of how much? 100, and assuming that it will also depreciate. It will also are depreciated for the same period. What will be the accumulated depreciation? You'll also do the same. 150,000 you divide by 8 years, multiply by 5. They give you how much? Yeah, 93. If you minus that, what will be our recoverable amount? Recoverable amount is 56. 50. So get the impairment loss. A minus B. $75,000. That is as simple as that way. It is as simple as that. Right? Is that okay? Now we continue. The other one is on restoration cost approach, which is Roman 2. First, we can dictate on the same. So you write on the restoration cost approach. Restoration cost approach. Write and say on restoration cost approach. Restoration cost approach. Write and say, under this method, the service potential of the asset to its impairment level, service potential of the asset to its impairment level, is the present value of the remaining service potential. Is the present value of the remaining service potential. The present value of the remaining service potential determined by subtracting the restoration cost of the asset, determined by subtracting the restoration cost of the asset, the restoration cost of the asset, from the current replacement cost, Let me just use this. So on the restoration cost approach, the restoration cost approach, we will get, this is how the depreciated replacement cost. The depreciated replacement cost is now what we are supposed to less the restoration cost. So that you get now the recoverable amount. Get the recoverable amount, so that you can now get the impairment note. Impairment loss. A minus B. Impairment loss, which is A minus B. All right, we do December 2014, question number 5B. December 2014, question 5B. December 2014. Question 5B, still on the same question that we're doing, Roman number 2. Same question we were doing, Roman 2. Now, on 1st January 2004, government built an office at a cost of 50 million. The building was expected to provide service for 40 years. On that 1st December 2013, after 10 years of use, a fire caused severe structural damage, and due to safety concerns, the office building was closed for repairs that cost 35.5 million. The repairs were made to restore the office building to occupiable condition. Current cost of the new machine is 100 million. Impairment loss to be recognized for the office building using the cost restoration approach. Using the cost restoration approach. We use shillings in millions. So we'll have the cost of the building is a office. It was of how much initially? 50. Let's say accumulated depreciation. Cumulative depreciation. Cumulative depreciation will be of how much? Now, the building had a useful life of how many years? 40. Useful life in 40. But it was in use for how many years? 10 years. So how much is it giving you? 12.5. So if you minus, what is our carrying amount? Yes? That is 7.5. That is our A. Now, if they replace, that is the new for the new machine now, the new office replacement cost of this what new machine will new office will cost them how much? 100 million. That's the accumulated depreciation. Accumulated depreciation will also be 100 divided by 40 times 10. How much? 20? 25. So get the depreciated replacement cost. Get the depreciated replacement cost. Given you how much? So how much are you getting here for the depreciated replacement cost? For the depreciated replacement cost, how much? 75. So we less the restoration cost. Restoration cost is of how much? 35. So what is our recoverable amount now? Amount will be how much? 39.5. So this is our B. So yeah, what is our impairment loss? A minus B will be what? Carrying amount as the recoverable amount is more than the carrying amount. Therefore, here we don't have any impairment loss. So such a case is whereby we do what we call the impairment reversal. Be able to see on that. Now, the last one is the service unit approach. Can talk about that. The service unit approach. Service unit approach. Service unit approach. See? And do now the service unit approach. The last one. Service unit approach. Say, under this approach, the present value of the remaining service potential of the asset, present value of the remaining service potential of the asset, is determined by reducing the current cost of the remaining service potential. Is determined by reducing the current cost of the remaining service potential. Current cost of the remaining service potential. Current cost of the remaining service potential before the impairment. Now here we are talking about any reduction. Any reduction will be having an impact here. So if there was anything that was affected and it was reduced by a given percent, we have to eliminate the percentage that was what? Reduced. For us to get the recoverable amount. Now from I think it was recently. Yeah, August 2024. August 2024. Question number 1A. Do that one. August 2024. August 2024. Question number 1A. Can do that one. August 2024. Question 1A. 5 years ago, the Ministry of Tourism constructed a public picnic facility to promote domestic tourism at a highly subsidized fee. Use the current paper, the one written up to December 2024. Now, the original cost of the facility was 750 million and is expected to provide services to 1 million tourists each year over estimated 25-year useful life. Due to economic hardship suffered by the citizenry, the number of tourists visiting the picnic drastically reduced. The revised estimate of the local number of tourists expected to continue with the visit approximated 14 million tourists over the 20 years. Current replacement cost of the new picnic will be 9 million. The facility is depreciated using the straight line method. You are required to lay the impairment loss on the picnic facility, if any. This is using the service unit approach in accordance with the National Public Sector Standard 21, impairment of non-cash flows generating assets. All right. We can have, this is shillings in millions. Shillings in what? Millions. So, shillings in millions. So, we begin again with the cost of picnic facility is of how much? 700 and what? 50, right? Less the accumulated depreciation. Accumulated depreciation will be of how much? 750. So divide by the useful life is 25. This was 5 years ago. They give you how much? So meaning that it was in use 5 years. How much is it giving you? 150. So what is our carrying amount? $600, right? We go to replacement cost. A new picnic facility can cost them how much? Replacement cost is 900, right? You less the accumulated depreciation. Depreciation to be 900 divided by 25 times 5. They give you how much? Yes? 180. So get the depreciated replacement cost. Replacement cost is of how much? 7? Now recoverable amount, we will less reduced percentage of tourists, right? Now tourists wata reduce how much? In 25 years, kama each year, ilikuwa ina attract how much? 1 million. In 25 watakuwa wangapi? Tunaambiwa watakuwa reduced how much? 14 million. So you just take 14. Hiyo ni reduction ya ngapi? From 25 to 14 itakuwa imereduce ngapi? 11. So 11 over 25 times 720. Na reduce ngapi? 3? 16.8. So minus, you get the recoverable amount. Inakupea ngapi? 403 point. Ama hapa hii unaweza ifanya tu this way. Wanabaki wangapi? 14 million. Si ndio? You divide by 25 times 720. You can also do it that way. It will just be 7. Because here we are looking at what is retained after the reduction. Sawa sawa. Wamebaki wangapi? Ni 14. Divide by 25 times 720. Yes, right? So what will be our impairment loss? A minus B will be how much? 196 point. That one you have the 10 marks that way. So by doing that, you have the 10 marks. Do the following now as assignments. Do the following as assignment. December 2023 question 3C. December 2023 question 3C. Do November 2019. November 20. Is it November? Should be. Wait. Yeah, November 2019 question 3B. November 2019 question number 3B. Question 3B. June 2013 question 5B. June 2013 question 5B. June 2012 question 1B. June 2012 question 1B. And December 2013 question 5A. December 2013 5A. So those are the questions that you'll do. And then we'll meet in our next class. I talk of what we call the earning per share. Earning per share, I said, is one of the areas that is commonly tested. So it's better we start with some of them as early as now. I will be capturing some of the areas that are highly tested as time goes by. You start preparing yourself early in advance. So, yes, so we can continue from there in our next class.